Hello guys. For the rest of the class, we're gonna talk about private equity, venture capital, and finally IPO. So first, we're gonna talk about private equity. I mean, we have partially known about private equity when we talk about leverage buyout, right? So at that time, we said that what is private equity? Private equity is basically uh, a bunch of private investors, right? Basically, they raise their financing from private investors, and then many LBO deals, the leverage buyout deals, are actually conducted by private equity funds or private equity investors. So, so then in this topic we're gonna talk about private equity in greater detail, and then in next one we're gonna focus on venture capital. But essentially, venture capital it's a subclass of a private equity, or it's a special class of a private equity. So we're gonna first talk about the private equity and talk about the structure of the private equity, and then we move on to focus specifically on venture capital. So basically, the idea of venture capital and private equity actually comes from the way we think about traditional investment and alternative investment. So traditional investment is basically, or like traditional assets are basically publicly traded shares like bonds. So for example, publicly traded shares like common stock, right? Stocks that are publicly traded on the stock exchanges. Also, traditional assets include bonds, right? They are fixed income security, which they include foreign exchanges, right? Commodities and real estate. They're traditional assets for investors to invest in. But how about alternative assets? Alternative assets, they focus on assets that have a limited investment history, right? For example, if you are a venture capitalist, you want to invest in a startup company, right? I mean, the company is basically, I mean, has been just started, right? Uh, I mean, there are only like one or two founders of the company, right? And the company was probably just started in a garage of one of the founders' home, right? So this particular asset has a very limited investment history. And also, those alternative investment have clearly differentiated features from traditional asset classes. For example, liquidity. They're very illiquid. Right? And also, it requires specialist skills to manage. Right? For example, um, the companies, I mean, there is a public company which had gone bankrupt, which had gone almost bankrupt, or the company is poorly managed. Right? So on one hand, the company has low liquidity because nobody wants this broken business, right? I mean, if you want to buy this company, you're just taking over a broken business, right? And second, if you want to take over this broken business, this broken company, you have to improve it, right? Now, improving a public company, it's not like, I mean, it's not like you are kind of improving improving the average grade of a class, right? That's much more difficult than that. So that requires specialist skills manager, right? For example, you need to have a professional manager who knows what to do with a broken company, right? And that's why these features make them less common in investment portfolios, right? I mean, in alternative assets, they are a big group, they are a big class, right? For example, they include art, films, notes, coins, ostriches, right, etc. They are all alternative investments. And startup company, they are also kind of alternative assets. Or a company that private equity like to buy, right? They are poorly managed, right? So they are all alternative assets because they have these features that differ from the traditional assets we are talking about, right? And among these alternative assets, venture capital and private equity funds, they are some of the most common alternative investment vehicles available to investors in the global marketplace. Right? And basically, private equity it's a general idea. Venture capital is a special case or special class of the private equity. So in general, if we leave venture capital firm for a second, private equity, which do not include venture capital firms, they can be used to fund troubled and distressed firms, right? Just like LBO deals, right? And when they are used to fund those troubled and distressed firms, these firms also encounter difficulty in raising capital for restructuring, right? And private equity can also be used to fund buyouts of large, stable, mature but underperforming firms, right? So these typical features are actually the features of the targets of leveraged buyout deals, right? Which we talk about, or like MBO deals, right? Management buyout deals, which we talked about last time, right? And in general, private equity and venture capital funds, they invest in high risk, high reward firms, right? Because they're engaging in risky businesses. Private equity investors, they do not use their own funds, right? They raise the bulk of their funds from financial institution and high net worth individuals, right? And venture capitalists, it's a special case of, it's a subclass of private equity, right? They provide finance for startup firms that require substantial capital to expand and cannot usually access it from conventional sources. I mean, in other words, you can understand the difference between private equity and venture capital, right? So venture capital and private equity, I mean, venture capital is a subclass of private equity. Therefore, venture capital, they have a similar structure with the private equity. The difference here is that venture capital is a special type of private equity because they invest in those highly risky startup firms, right? And then these firms, they require substantial capital to expand, all right? And then they cannot usually access it from conventional sources, right? That's the specialization venture capitalists have, right? Because they know how to, uh, because they know that startup firms are very risky, right? And they know how to kind of provide financing to startup firms, right? They know how to help a startup firm to expand, to develop new technology, right? And finally to go IPO, right? So that's kind of the idea. So that's what we're gonna start from talking about private equity, and then we're gonna go into venture capital. But keep in mind that some of the problems VC have were also faced by private equity investors, right? Some of the problems private equity funds have are also kind of common for those VC capitalists, right? So because they share something in common. So from the perspective of PE investors, right? So basically, in this game, you have three parties, right? The first one is the entrepreneur, right? So which includes manager and owner of the businesses, right? And then the second party is the ultimate investors, right? So which includes the providers of the capital. So these providers of the capital, they could either, I mean, providing capital directly or through an intermediary, right? If they provide a capital directly, then they are basically wealthy individuals, right? Or angel investors. If they provide capital through an intermediary, then this intermediary could be pension funds, right? So the third party in this game is intermediaries, right? So like like managers of private equity, right? Or venture capital, startup funds, right? So they add value by providing expertise, monitoring, and diversification. Right? For example, for venture capitalists, they provide expertise in this technology. For example, right, if they're trying to finance a startup firm, right? Also, they monitor the management of the VC firm, right, in order to make sure that they are trying to maximize the firm value. They're trying to uh, they're on the right track, right? Basically, and also they they also try to be diversified, right? For a private equity firm, for a venture capital firm, they always try to be diversified, meaning that they invest in a couple of firms at the same time, right? In order to diversify away the risk. Because each firm to them is very risky. That's why, right? So now let's focus on the private equity market. So the private equity firms provided a substantial part of the fuel for the M&A boom during 2003 and 2007, right? So we talked about this earlier when we talk about LBO, right? Leverage buyout. And the kind of the rising of the LBO deal is actually accompanied by this M&A boom, right? During 2003 and 2007. And we say that there was this M&A boom, which was driven by private equity firm because the interest environment at that time was very favorable, right? There's a low interest environment. Therefore, private equity firms found it easy to raise financing, to raise debt in order to finance their LBO deals, right? So the private equity market is essentially a collection of funds that have raised capital by soliciting investments from various large investors. And the funds will be invested in equity positions in company, right? And so when these investments acquire, so when these investments acquire 100% of the outstanding equity of a public company, we have a going private transaction, right? So we talk about this definition previously when we discussed the LBO deals, right? And when equity is acquired through the use of some of the investment capital of the private equity funds, but many borrow funds, then the deal is called leverage buyout. Right? Again, if you still remember when we talk about what's a leverage buyout, right? The leverage buyout is a deal where it's mainly financed through the assumption of large amounts of debt, right? So this is LBO. And this graph shows the private equity activity as a percentage of all merger acquisition activity. Right? So you can look at this graph, right? You can see in general, this private equity activity is actually kind of consistent with the trend of the overall M&A activity. Right? When M&A goes up, private equity is also more active, right? When M&A cools down, then private equity also cools down. So in general, private equity funds seek out investment that are undervalued. And private equity fund managers, they raise capital from a variety of institutional investors. And they typically charge their investors 2 and 20. So the 2 and 20 refers to the following fact, right? 2% of invested capital and 20% of profits. And this 20% of profits, they are referred to as the carried interest, right? So in some way, this is actually similar to a hedge fund, right? So in a hedge fund, they also charge about 20% performance fee, right? So this is also similar. So now we're gonna distinguish a little bit between PE and the VC, right? Like I previously said, venture capital funds, they often make investments in startups that might have limited revenues, right? So yeah, so that's why for this reason, I mean, venture capitalists, they invest in highly uncertain, therefore highly risky firms, right? Because these firms, they have little information, right? So that's why they also have little to prove the future success, right? So private equity firms, they seek out more established companies that have lengthy revenue. And these private equity firms, they actually invest in those like big firms. I mean, even if they have they're broken, right, in some sense, but they still have a history of earnings, right? History of revenue, history of performance, right? I mean, and in other cases, like I just mentioned, right? private equity firms, they also invest in those mature, stable, but underperforming firms, right? These firms are even better, right? They have longer history of those uh, past performance, right? In some sense, back to our point just now, right? So VC capital, they invest in highly uncertain because these firms, they have little prior history. So in the venture capital business, we may have several rounds of funding, whereas in private equity, the fund typically acquires the company, holds the business for a period of time, and then sells it off at a profit, right? So this is the major difference. I mean, in some way, why do we need several rounds of financing? Because of this highly uncertain nature of the VC. So because of the highly uncertain nature of the startup firms VC invested in, they need these startup firms to kind of reach a certain milestones to continue to receive financing, right? It's almost like I don't know about this VC, so I don't know whether this startup firm will be successful because there's no history, right? That's why I set up a bunch of milestones, right, for the firm to make, right? If the firm does not make to the first milestone, right, of course I will not provide further financing, right? So this is to minimize my exposure, right, to the failure of this company. That's why in the VC business, right, we require several rounds of financing, right? We don't provide financing all of a sudden, right, because we are unsure about the future of the company. And because of this highly uncertain nature, the investment horizon for venture capital funds, they can be shorter. And additional capital is provided only if the company meets the milestone, right? If you make up to the, so if you have proven, let's say, the success. So for example, if you have proven the success of your technology, of your first bunch of technology, right? I will provide further financing. Now, then after a couple of years, after you have increased your sales, after you have expanded for a couple of cities, right? For example, for Uber, right? After you've proven that you are successful, right, in providing services in a couple of major cities, I will provide further financing, right? So these are all milestones, right? So that's why it is common with venture capital investment that business needs multiple rounds of funding over its life. But on the other hand, most private equity acquisitions that are non-venture capital, they are self-funding and are able to maintain themselves through their own self-generated cash flow. Right? And also, there's usually much more uncertainty about the success of company venture capital investing, right? So like I just talked about. Roughly 1/2 of all VC founded companies fail, right? And there been so but the success of their businesses depends on only just like one or two, maybe two or three companies they invest in, right? Because the idea of their investment is that they invest in a couple of VC business, right? And then they know that half of them or even most of them will fail. But as long as one succeeded, as long as one or two or three succeeded, that will be a tremendous success, right? They will make the probability will be, or the return for them to make through a successful startup firm will be tremendous, right? So that's why on average, they're still gonna have, reasonable returns overall as a portfolio, right? So that's why if you look at the distribution of the returns of, let's say, the distribution of the returns across different companies in their portfolio, it's highly skewed. And it's highly skewed that one or two companies has extremely high returns, like 300% returns, right? But most of the company may only have negative returns, right? Negative, let's say 20% returns. Well, there are some studies who find that the mean alpha for these VC firms is like 32%, right? But keep in mind, this mean is driven by only, let's say, half of the successful firm, or like even a smaller proportion of the successful firm. Yeah. So this is the nature of the VC capitalists. That is, most of the company they invest in are gonna be fail, right? But the a kind of small scratch of those successful firms are gonna deliver a handsome return. Yeah. But in contrast, the business failure of a private equity acquired business is much less common. So, and companies private equity funds invest tend to have similar risk characteristics of the market overall, right? So the average beta, so the beta captures the riskiness or the co-movement of the company with overall market. The average beta is 0.86. And PEs need to be able to purchase target companies at the prices that allow them to achieve a particular hurdle rate of return. Right? So this is the tricky part of the PE negotiation, right? If you are private equity funds but not like VC capital, when you talk to a target, right, you need to negotiate with them the valuation, right? Just like any merger partner will do, right? So when PE firms believe that a target has been poorly managed, there might be a greater gap between the value that the private equity believes they can readily achieve through constructive changes, right? And the current value of the target based on its unadjusted future cash flows. So what are the constructive changes private equity can install, right? For example, they can install a new management team, right? Because they believe that the current management might not be able to manage the current company well, right? So that's why they can replace their own managers and improve the company's standing. So that's why if the PE firms, they believe that the target has been poorly managed, right? Then this gap is going to be greater, right? Then this provides flexibility for those PE firms when they negotiate with the target, when they negotiate with the seller about the prices. But if the target is well managed, then there'll be less room for this negotiation, right? Then in extreme cases, negotiation might fail, right? Because they cannot agree on the prices in that case, right? So in general, if we look at the transactions PE funds have done, right? The important part of it is large going private transaction, right? So taking a public company private, they are still an important part of the private equity businesses, right? And but among those all transactions PE firms have done, more common transactions, they are private deals, right? So these involve acquisitions from founders of businesses, right? Other sponsors or venture capital sponsored firms, right? So so one of the exit strategy of VC capital is, for example, when a company is mature, when a company has reached certain milestone, right, they might consider selling it to a private equity firms. So the increasing prevalence of private sellers have provided private equity buyers with increased risk, right? I mean, unlike public company, right? If it's a public company, the information is transparent, right? You can read the financial statements, right? You can talk to the manager, right? Everything is public. There are more analysts covering the company, so it's more transparent. But if you're talking with private sellers, then there's greater uncertainty there because the information about this private firm is less available, right? So there's more uncertainty regarding this private firm. Yeah. And that's why many of these deals include a survival clause, right? The survival clause indicate that the representations made by the target might survive for only a limited time after the closing period, right? So that's why in acquisitions, private companies, a whole host of concerns about the reliability of the data in the seller's financials may arise, right? Because for a public company, I mean, there's no question about whether the financial information provided by the company is true or not, because it's just regulated by SEC, right? So, I mean, they got to be right because it's regulated by the authorities, right? But for private firms, because they are not required to disclose any financial information publicly, that's why the credibility of the data they disclose is a question. right? So the Delaware Court ruled in 2011 that the survival clause served as a kind of statute of limitations on the ability of the buyer to pursue breach of contract claims. Right? So in our case, this is a actually legislative change that will impact the private equity businesses, right? Because the survival clauses serve as a kind of statute of limitations on the ability of the buyer to pursue breach of contract claims. So that's why private equity buyers have dealt with this change by securing reputations and warranties insurance, right? So why do they need this insurance? Because they are afraid that after maybe, I mean, when they are, when the deal, when they are when they finish the negotiating with the seller, right? They found out, or maybe the data is not right, right? Maybe there's a financial fraud after they close the deal. In that case, they need to sue the target, right? So then there'll be a couple of legal disputes out there. That's why this insurance will make sure to compensate them for these losses, right? If they don't want a deal, if they want to back out a deal, there will be a choice. Another trend is that representatives of the private sellers are including in agreements with private equity buyers more significant reverse breakup fees, right? Because these private sellers, they're also afraid that those private equity buyers might actually come in the deal, right? Because I mean, if they find out maybe the information later, right, they don't find a target attractive anymore, then they might quit. So that's why, and another reason here is that, I mean, because private equity buyers, they have to secure financing, right? They have to secure financing in order to buy the target. That's why if anything happens, if maybe there's a credit crunch, right? Then and the kind of financing becomes a problem. The financing is difficult to obtain. In our case, the deal might be difficult to complete, right? So in our case, this reverse breakup fees that needs to be paid by the buyer when the buyer doesn't want a target or cannot pay for the target. This can create an incentive to make sure that the buyer pushes the banker to provide a needed debt capital to complete it. So in general, when we look at leading private equity firms, these are the leading private equity firms like Blackstone, KKR, right? So Kohlberg, Kravis, Roberts, and Warburg Pincus, right? So these leading private equity firms, they are chosen based on 5-year fundraising, right? But based on the fund that they're able to raise. So now we move on to the structure of the private equity. Yeah. So private equity funds, they are usually established as limited partnerships run by a general partner, which is called GP. The private equity firm and the number of investors are limited partners, right, which are called LP. So the general and the limited partners, they enter into agreements when a fund is formed. And private equity funds, they may tie up their investors' capital for an extended time period, right, such as 10 years, right, which is the typical lifetime of a fund, right? The agreements usually require them to invest the capital within 3 to 5 years, right? And that time period is referred to as the investment period. So this graph describes the typical structure of PE firms, right? You have an investment phase, you have a payoff phase. Right? So in the investment phase, general partners like GP, they put up 1% of the capital, right? Because they are, I mean, what do the GPs do, right? The GPs are mainly responsible for managing the fund, right? Monitoring the fund, managing the fund, right? So talking to the companies in the fund. And then they earn the management fees, right? But the LPs, right? LPs are typically the parties that provide the financing to the fund, right? So they're typically putting 99% of the capital of the fund, right? Now, in the investment phase, the GPs, they are responsible for investing in diversified portfolio companies. So there could be N companies, right? Now, after a couple of years, this company might actually, for example, you have taken a public company private and improve the performance of the company, right? Then after a couple of years, you might want to push the company to go IPO again, right? Basically you have entered the payoff phase, right? So in the payoff phase, this is the time where the GPs are gonna charge those performance fee in a way, right? So they will get carry interest of 20% of the profits, right? For example, if they sell the company to another party, right? If they push the IPO of these managed companies, right? Then they're gonna get 20% of the profits, right? And limited partners, they get investment bank and also the 80% of the profits, right? So this is the typical structure of and the timing of this, the general PE. You know? So the GPs in the private equity, they actually can earn two parts of the income, right? The first part is a fixed income. This fixed income is independent of the performance of the funds. So which includes the management fees, right? No matter how the fund performs, I mean, the GPs are responsible for managing the fund anyway, right? And the second component is the variable income. So the variable income is a function of the performance, right? So if the profits are higher, they earn a higher variable income. If the performance is poor, they earn lower amount of the variable income. You know? And for this management fee, they are paid from committed capital from LPs. So committed capital is coming from the LPs at the upfront, right? And committed capital is composed of lifetime fees and investment capital. So, and for those variable income, you have carry interest, right? Carry interest is like 20%. So this carry interest is earned from gains on the transactions conducted by the GP, right? And how GPs can make income is determined in agreement with LPs, right? For example, it could be that a GP doesn't earn any of this type of income until the LPs have received back their capital, right? This could be written in agreement between the GPs and LPs. And this agreed upon amounts could be higher if a hurdle rate was agreed to, right? This hurdle rate's like required return by LPs, right? For example, it could be 6%. And let's look at one example, right? Assume the LPs, they committed 250 million to the fund, right? And proceeds from exceeded investments totaled 300 million, right? So in our case, LPs would receive not only their 250 million back, but also 6% of that amount. Now, this is the hurdle rate. I mean, this is like the minimum return you need to guarantee for your LPs, right? So that's why this 15 million is it's like the minimum return, minimum kind of investment return. Right? And the percentage of the remaining gains, 35 million, right? So that's 300 million minus 265 million, right? Those would be paid to the GP. Right? The percentage of the applicable profits that is used to calculate the GP's earnings is called a carry level. So a very common carry level, carry interest level is 20%, right? Just like we talked about. So, and the rest of the variable income GP earn are monitoring and the transaction fees, right? Because the monitoring is done by the GP, right? Again, like we talk about GP, they're responsible for monitoring the fund, monitoring the performance of every single company in the portfolio of this PE firm. So the monitoring is done by the GPs, right, which oversee the operations and the performance of the companies they have acquired. So now you can see in this structure, you have an agency problem here, right? Why is the agency problem? Because the GPs, right, they are responsible for investing the money they get from the LPs, right, in the companies, right? So that's why the LPs, right, they're the principal. They delegate the rights of management to the GPs, right? So that's why LPs, they want to make sure that the GP has maximized their value, right? GP has done a good job in kind of investing their money, right? So that's why LPs used to be relatively passive, but with, I mean, in kind of recent years, they're becoming more active in kind of pushing the GPs to make sure that this process is more transparent. Right? So the strong equity markets enable private equity managers, the GPs, to more easily to be able to meet the expectation of the LPs, right? And private equity managers, they have to work harder for their returns, and they find themselves under closer scrutiny from LPs, right? If the market doesn't go well. I mean, there could be good times, there could be bad times, right? In bad times, the market doesn't go well. That's why it'll be harder to deliver the expectations. So in that case, LPs will be paying more attention to GP's performance. So that's why LP activism is, so that the thing we call LP activism, right, which refers to the fact that LPs are kind of very active in monitoring the GPs, right? So this kind of LP activism, it's not very popular when the market is good, because when the market is good, it will be easier for the GPs to deliver good returns. So in that case, the LPs will be tends to be vigilant in monitoring fees and expenses charged by the GPs. Right? When the market is bad, then the GP's performance, the GP's fees are under closer scrutiny. So in 2014, I mean, this LP activism is triggered when some pension funds demanded better explanations and justifications from private equity funds they have invested in regarding the fees and expenses they were charged. Right? And in 2010, the Dodd-Frank legislation required that the private equity firms with more than 150 million in assets had to register with the SEC, right? So if they have to register with the SEC, then they have to be super transparent about the fee structure. Right? So this pushes the GP to be very transparent about the fees they charge and how they charge. Right? And during this LP activism, right? So some LPs wanted to hire independent advisor to look over the various fees that the funds had charged. Right? Some funds also demanded that the terms of the GP's compensation agreement to be kept a secret. Right? And the LPs are trying hard to kind of make it more transparent. Right? I mean, why do some funds demanded that the terms of the LP's compensation agreement to be kept secret? Because I mean, many of these kind of GP's compensation, right? So I mean, if LPs sees the GP in a very high share of the kind of profits, and the GPs do not disclose to the LPs, right? Then this will become a problem. Right? So that's why monitoring here is very, very important, because GPs are investing on behalf of the LPs. Right? So next, we're going to talk about the expansion and diversification of private equity firms. Right? So through all these years of the quick development of PE firms, right? Many, for example, Blackstone private equity have become really good global asset managers, right? And some of the private equity funds, they have started to emphasize this in their capital raising and have moved away from the use of the term private equity and prefer alternative asset managers. They're trying to be more diversified. That's why they invest in lots of diversified assets. And another type of, a very special type of private equity deal is called club deals. So in the club deals, it's not just one private equity buyer. There are many private equity buyers. Right? So the private equity funds, they might acquire stock in the target company individually, or they might combine with other private equity firms to acquire a target. And these types of deals are sometimes referred to as club deals or consortium deals. Simply because I mean, there is a club of buyers there. Right? So, and these type of deals are sometimes referred to as the club deals or consortium deals, right? So the advantage of this club deal is that because there are a couple of private equity buyers there, they help them to spread out the risk, right? It's like there's a 100 million risky investment, but if each of them is taking, let's say, 20 million, then it's not that risky for each individual of them, for each fund of the whole club, right? So to further diversify away the risk, right? Many funds actually have this requirement, and this requirement is that no more than a certain percentage, for example, 10% of a fund's assets will be invested in any particular investment. Right? For 100% acquisition, a 10 billion fund would then be limited to acquisitions no larger than 1 billion if it chose not to utilize that to complete the transactions. Right? So for example, in March 2005, right, this private equity firm, Silver Lake Partners, completed the second largest LBO up to that time when it combined with 6 other private equity firms to acquire SunGard Data System for 10.8 billion. Right? And the other private equity firm that participate in the takeover were like the top private equity firms we have mentioned, right? Blackstone Group, Holbrook Kravitz, Robert, this KKR, and Texas Pacific, Goldman Sachs Partners, and Providence Equity Partners. Right? And these people by officer and all, they find that the club deals tend to lower the pool of potential demanders for target companies. Right? Thereby, it also lower the prices that the targets receive in the market, right? Because if you have a group of buyers, if you have there are only that many buyers out there, private equity buyers out there, right? So that's why if there's a club deal, that means if you want to find outside option, if you want to find another buyer, that will be harder, right? Because more and more bidders, they're already in this club. That's why if you wanna find another buyer, it will be harder, right? So then this creates a greater bargaining power, right, for the buyer, right? Because this has limited the outside option that the targets can seek from. And because of this fact, right, the club deals, they have become less popular in recent years. So what is the business model of the private equity? Right? The business model, when we talk about LBO, I have talked about already, right? So the basic idea is that they find those underperforming firms, right? And they buy it, they fix it, right? They fix the problem and improve it because their managers may be better. They have talents in improving the company, right? And then they sell it. They push the company to IPO, and they earn the performance improvement as a profit. Right? So in this business model, in the first step, they need to convince the investors to invest into a fund. It's just like advertising, just like sales, right? Then the next step is to find undervalued targets, right? So you need to find those targets that are undervalued, right? Undervalued meaning that the manager is not doing well, right? And also the target has a great potential, right, to be improved. So if you find this acceptable target, which are undervalued, right? And then you need to talk to the target, right? You need to negotiate with the target about acquisition price, right? So then after you guys agree on a acquisition price, then the GPs will secure the debt capital using their relationships with the banks. Okay? So it's like if you want to do a leverage buyout, right? You need to secure the funding from the bank, right? And usually private equity buyers, they use the cheap debt to buy undervalued target. That's why they use, sometimes, in many cases, they will use like junk, right? Junk bonds are very cheap. It helps if the targets do not already have significant debt, right? So because if you already have a significant debt, the room for taking more debts will be limited, right? So that's why when the target doesn't have significant debt already, buyers might want to have the target acquire more debt, right? And they can even use it to pay themselves a dividend. Well, so why do they want to pay a dividend? Because they oversee the acquired company, which is run by its own management, and they charge the monitoring fees for the oversight. And an ideal environment for the private equity firm is one where the market is rising, right? Because if the market is rising, so I mean, if the market is rising, this helps the boost of the value of the firm they acquire. Right? This allows them to buy at one price and then later they sell the target in an elevated market at a higher price than they would pay. Right? So when the market is rising, such as 2013 and 2017, then the cost of debt is low. Right? I mean, the cost of debt is low, and also this helps to boost the value of the private equity's investment targets, right? So that's why they can exit with a profit. There are many exit strategy for private equity firms. Why? One exit strategy is through a sale to a corporate buyer, right? And this corporate buyer might see the acquisition as a complement to its overall business strategy, right? But when the economy is weak, then those buyers could be difficult to find, right? Another exit strategy is a sponsor-to-sponsor deal, right? I mean, you can sell to another private equity firm, right? And another one is public offering, like going IPO again. Right? The private equity firm sponsors a public offering in the stock it owns and its prior acquisition. Right? So in 2013, I mean, actually, this public offering exit strategy is very common. In 2013, offerings by private equity firms were roughly half of all IPOs. And one of the very, very popular operations the private equity firms did to those firms they acquire is called dividend recap, right? So what's a dividend recap? Dividend recap is when private equity firms that have acquired companies take more debt to kind of take on more debt for the firms they acquire, right? So how do they take on more debt? They issue bonds and use the proceeds to pay a dividend to the founding investors, right? For example, in 2004, KKR had a Pan Am's debt issued 250 million in notes, right? And then these notes were used to pay the investors dividend. Again, I mean, this is just like a leverage buyout, right? I mean, in other words, this is also called leverage recap, right? Because they increase the leverage and it also, I mean, increase the leverage, right? Increase the debt, right? They use the debt to pay dividends, right? That's the idea. And during 2003 and 2007, private equity were able to negotiate very favorable conditions with the lender. And part of these favorable conditions involve the granting of covenant-light loans, right? What are those covenant-light loans, right? These loans, they don't have restrictive covenants that require certain financial performance, right? Such as the maintenance of specific financial ratios, right? And bridge financing, so this is another type of financing that private equity firm usually need to secure during the deal process, right? This bridge financing is the capital that is provided to allow the GPs to complete the deal while they wait for long-term financing to be worked out. Right? So bridge financing is riskier than long-term financing that is associated with a closed deal, right? Because long-term financing is about a closed deal, right? But bridge financing is the money you have to pay in order to close the deal. Right? I mean, so that's why bridge financing is more risky because there are greater chances of not being able to close the deal. Right? For example, all of a sudden the market is going down. Right? So that's why it will be harder for the private equity buyers to complete a deal. So for this reason, private equity firms they'll try to avoid using it. Right? They'll try to use their own financing to complete a deal. Right? So a related regulation in this regard is DGCL Rule 200, 251H, right? DGCL is Delaware General Corporation Law, right? So this article says that private equity buyers, they have long been in a disadvantageous position relative to strategic buyer when it comes to tender offer, right? So strategic buyers are corporate buyers who see a strategic fit, right, between a target and an acquirer. So why there is a disadvantage here? Because private equity buyers, they face the risk that the deal would or would not be approved by selling the shareholders in the closing or second step transaction. So remember, in a tender offer, we have a first step tender offer and a second step merger. Right? So that's why in the second step, private equity buyers have a greater risk of the target shareholders not agreeing to the offer made by the private equity buyers. So this Rule 251H allowed the buyers that receive a simple majority of the target shares in the tender offer to quickly close the deal rather than having to wait for a shareholder vote, right? So this gives private equity buyers some benefits, right? So this improved the competitive landscape for those financial buyers such as private equity firms, right? All those strategic buyers who are using debt financing compared to strategic buyers who may be using their own cash or stock, right? Because if you have to wait for a shareholder vote, then this creates a problem for bridge financing, right? Because you need those bridge financing to complete the deal. Right? And finally, we're gonna talk about the returns of private equity funds, right? So one way to calculate the private equity internal rate of return is basically use this formula, right? So this is, I mean, it's just like taking a risky project. So VE is the value of the investment at the end of the measurement period, right? For the private equity funds. This VB is the value of the investment at the beginning of the measurement period, right? This CFI is the cash flow I, right? If you if you invest a couple of company, you're gonna have cash flow each period, right? And then this I is the number of cash flow during the measurement period. This small r, this is the annualized internal rate of return, right? And then this TI here is the number of calendar years from the day when a cash I occurred to the end of the measurement period. This TD is the total number of calendar days within the measurement period. So basically, the value investment at the end of the measurement period will be equal to two things, right? One is the value of the investment at the beginning of the measurement period, right? And then this is the value of that compounded, right? Compounded to now, right? Compounded by the kind of number of days have passed, right? So this will be the first part of the first part of that kind of analysis. And this CFI, the second part is the value of those cash flows, right? The value of cash flows PE funds receive, right, during the measurement period. So when an investment, so this is, I mean, when we look at this one, right, we use the annualized internal rate of return, right? But sometimes it will be useful to look at the non-annualized internal rate of return. Right? So this happens when an investment covers only part of a year, and there is no guarantee that proceeds from a given investment could be reinvested at the same rate the remainder of the period, right? Then in that case, it will be useful to use non-annualized, in other words, since inception internal rate of return, right? This rate of return is not annualized. It's just the rate of return starting from the beginning of the measurement period. So this number will be equal to 1 plus the annualized internal rate of return, right? And then to the power of how many days have passed out of 365. That's the number of days in a year, and minus 1. Right? This is the non-annualized rate of return, internal rate of return for private equity funds. I mean, again, the idea is that in many cases, right, if you assume compounding or annualized rate of return, you're assuming that for every year you will be able to use that kind of return. You will be able to earn that rate of return. You'll be able to reinvest your investment income using the annualized return. right? But in many cases, it's not a case, right? You might exit in the beginning, right? You might exit in the middle, actually, right? So in general, Kaplan and Shaw, they compare the internal rate of return, right? So they calculate the internal rate of return generated by the PE cash flow and then compare them to a public market equivalent, right? So they find that private equity returns, they were roughly similar to that of the market as reflected in the SP 500, right? So in that case, this implies that private equity funds, they in general do not have excess return. But later research, they have used the newer data sets, right? Newer information. They do find some excess return. And also, Kaplan and Shaw, they find persistent private equity returns, right? In other words, they find that the performance is persistent for private equity funds. And so, what is the persistence performance? Persistent performance means that if you have good performance in one of your funds, then you are expected to have good performance for another fund you manage as well, right? So your performance is persistent throughout the funds the private equity firm manages, right? So that is your performance for fund N-1 will have some predictive power, positive predictive power for the performance of the fund N that is managed by you as well. In other words, the performance of the funds, or the performance of the two funds managed by a same private equity firm will be highly correlated. So this particular finding of performance persistence actually is in stark contrast with the research on mutual fund managers. Right? In mutual fund managers, they don't find persistence of the return. Right? In particular, Chang 2010, he finds that performance was persistent for the first follow-on fund, but not subsequent ones. So this pointed to the fact that there are some persistence of fund, but this persistence of fund is actually weak. Right? So another paper by Korteweg and Sorensen in 2014, right? They use this sample of deals from 1969, 2001, right? They find that even if the performance is persistent, but the performance is quite noisy. The past performance were quite noisy, right? And luck, right? The performance driven by the luck play an important role, play a great role in evaluation of the persistence, right? So that's why, in general, the ability of the LPs to identify the persistent performance of some funds were actually limited. Right? So most of it is driven by luck. So the general challenge in PE valuation, right? I mean, in kind of evaluating the performance of the PE funds is usually it's not a liquid market for the assets of some funds. So that's why it is difficult to put on a number, put on a valuation for the assets that the private equity funds manage, right? So the researchers, they have to use the fund's own estimates of net asset value, right? And the other challenge is that there'll be a challenge to determining the performance of funds, right? This challenge is that the accurate value will only be known after all the assets in the fund are sold, and this may take a decade, right? So you only know the value of the assets private equity funds manage, right? When they actually sell all these assets, right? Because you don't observe the value, right? I mean, you don't observe the value of these assets before they sell out, right? Because I mean, for example, a private equity fund, right? They bought a broken firm, right? I mean, you cannot say the value of the company is the value private equity pay, right? Because the value of the fund is that they will have superior managerial talent, right? They can improve the fund, right? That's why the value of the private equity fund is actually reflected in the final value they are able to sell to another firm, right? But Then this may take a couple of years, right? For public firm, it may take like, remember, the life of a private equity fund is like on average 10 years, right? So you need to wait for a couple of years to see that value coming up. So this paper by Filippo and Gottschalk, 2009, find that average funds underperform the S&P 500 by 3% after taking fees into account, right? If you do not take into account the fees, then they found that the funds outperformed the index by 3%. So taking into account the management fees here is very important. And for newer studies, they analyzed the returns of a large sample of 1,400 buyouts, right? What they found is that private equity funds consistently outperform the market by between about 20% and 27% over the average fund's life, right? This is the non-annualized rate of return, internal rate of return. And this translating to more than 3% annually, right? So again, this is before fees, right? Harris et al., this paper compared investment in a given private equity fund to equivalently timed investment in S&P 500, right? So basically, they compare this to a public firm in order to get its PME, that public market equivalent, right? So what is the public market equivalent? So for example, if a public market equivalent is 1.15, right, this implies that by the end of a given fund's life, the investors in the fund derived 15% more than what they would have had they invest in the S&P 500, right? So meaning that they can beat, right? They can beat the S&P 500 by 15%. Right? That's the idea. So these people also find that the average VC funds underperformed relative to the market by approximately 5%. This is the non-annualized return, right? So again, this is after taking into account the fees, right? So in general, there are some concerns we studied who found excess return, excess positive return, right? Because your estimate of the fund value might be problematic, right? Because some funds might actually overstate their returns. So then the question is the market able to identify and penalize those GPs who actually manipulate and overstate their returns? Well, this paper find that GPs with overstated results tend to have more difficulty in raising future capital, right? This is a reputation effect. So there is some penalty to this overstatement of the return. So because private equity funds, they cater to a limited number of investors, right, who are typically large institutions. That's why small retail investors, they cannot invest in private equity funds. And private equity funds, they tend to invest in smaller or mid-sized companies that have low EBITDA multiples, right? Basically value stocks. They have the potential. They are currently undervalued, but they have potential to grow to a higher level of the value in the future. Right? And private equity investments and the returns, they feature long holding periods, right? And also significant investor activism, right? Because private equity funds typically acquire entire companies and have their representatives on the board when they handpick the manager. So this is a feature of the private equity investments. So this paper by Eric Stafford find that individual investors, they can actually replicate many of the characteristics model except for the activism part. Right? So the portfolios composed of the firms with characteristics similar to those chosen by the private equity funds. If you kind of replicate the private equity firms' portfolios, right? You can actually earn high risk-adjusted returns, right? Exceeding the mean pre-fee equity return. Right? That's kind of the finding they found, and this is the realized return. Right? So, this is also consistent with the trend of the private equity activity, right? So, in good times, the kind of realized return is better, right? And finally, a special question here is that does the board interlocks affect the likelihood of the target to receive private equity bids, right? Board interlock meaning that whether your directors on the board have experience before to receive private equity offers, right? So this paper by Stewart and Yim find that previous positive experience in receiving private equity bids, while at other companies actually received the chances of receiving offer again. Right? So if you have directors who are sitting on the board and they have the experience in receiving offers from private equity firms before, right? So you're more likely to receive private equity firms offers. Right? When the directors had a negative experience with private equity in the past, then this effect disappears. So this is, and finally, because retail investors they are not able to invest in private equity funds, right? Because the private equity funds they are open only to wealthy individuals and large institutions, right? So that's why in general they can only invest in those publicly traded private equity funds. So, but in 2014, there's a secondary market that is open to retail investors, right? So this secondary market took a step forward when the KKR allowed investors to sell portions of their stakes in the buyout funds through a private market managed by the Nasdaq OMX group, right? So in this private market, private investors they will be able to invest in the shares of the private equity funds. So this is so much for the private equity firms.